By February 2009, the global economy was effectively in the ICU. The Dow had plunged below 7,000, and regular people were pulling cash out of their banks and quite literally hoarding it in the dirt. Retail investors were not the only ones panicking. Wall Street veterans were openly weeping on financial networks. They were convinced the equity values of major financial institutions were about to go entirely to zero. One word was echoing across every trading floor: nationalization. The prevailing theory was that the United States government was preparing to seize the failing banks outright, wiping out shareholders completely. But inside a quiet office in New Jersey, far removed from the Manhattan hysteria, a man sat at his desk. He squeezed a round stress ball, looked at his traders, and gave a simple directive: buy everything. While cable news experts suggested he was committing financial suicide, he placed a $7 billion bet on the survival of Bank of America and Citigroup. To understand how David Tepper extracted billions of dollars from an apocalypse, we have to look at the specific data he was analyzing while the rest of the street was watching the news. Tepper grew up in a middle-class neighborhood in Pittsburgh. He possessed a rare cognitive trait: a photographic memory. He could memorize decades of baseball statistics with perfect clarity, treating numbers not as isolated digits, but as continuous logical stories. He eventually landed on a trading desk at Goldman Sachs, where his raw talent quickly generated massive profits. Yet the firm denied him a partnership 3 separate times. Management viewed him as too loud, too aggressive, and unfit for their polished corporate culture. Realizing he would never be accepted into their club, Tepper left the firm in 1993. He rented a modest office space and launched his own fund, Appaloosa Management, with $57 million in seed capital, a tiny amount by Wall Street standards. Being pushed out of the elite banking machine gave him total autonomy. He no longer had to answer to the institutional groupthink that dictated how the major banks operated. He built a system that answered only to his own raw logic. Appaloosa specialized purely in distressed investing. Tepper's philosophy was straightforward. When a country or a company catches fire, you don't show up with a fire extinguisher. You pull up with an empty dump truck and load up on cheap assets. He had tested this during the Black Monday crash of 1987, ignoring the hysteria to scoop up the bonds of strong companies that everyone else was throwing out in the panic. This strategy required an enormous capacity to absorb pain. During the 1998 Russian ruble crisis, Tepper bet wrong. A Russian sovereign default tanked his fund by 29%. Instead of panic selling, he held his nerve, trusted his timeline, and recovered the losses the very next year. Following the September 11th attacks, investors aggressively dumped aviation stock. But Tepper recognized that air travel was a permanent human necessity. He bought the distressed debt of bankrupt carriers, waiting patiently for the inevitable government bailouts and industry recovery. Time and time again, his success hinged on a single variable. He generated his alpha by identifying the difference between temporary trauma and permanent structural collapse. This brings us back to the banking crisis of 2009. The market was so thoroughly broken that even legendary investors like George Soros and Bill Ackman were paralyzed on the sidelines, waiting for clarity. Tepper tuned out the financial news networks. Instead, he pulled up the U.S. Treasury's Financial Stability Report and started reading the actual text. Buried in the dense formatting was a specific clause detailing the government's plan. It explicitly stated that the Treasury would allow banks to convert their preferred shares into common equity. That meant the government intended to keep the banks alive. There would be no nationalization. He mapped this out as an asymmetric bet. If his reading was wrong and the major banks went to zero, the entire global financial system would collapse. In that scenario, money loses its value entirely. But if his reading was correct and the system survived, the trade offered unlimited upside. He would walk away the richest man in the room. The downside was capped by the threat of total economic ruin. The trade was a massive bet on a single discrepancy: the distance between the public's emotional panic and the Treasury's published intentions. By the end of 2009, Bank of America shares shot from $3 to $18. Appaloosa Management generated a 132% return, yielding a $7 billion profit. Tepper's personal take was a staggering $4 billion in a single year. His market influence grew so large that in 2010, a single CNBC interview where he decoded the Fed's quantitative easing policy telling investors simply not to fight the Fed, spiked the entire S&P 500 by 2%. Traders literally named it the Tepper rally. But raw logic has boundaries. In 2018, Tepper bought the NFL's Carolina Panthers for over $2.2 billion in cash. His tenure has been widely criticized, earning him a reputation among fans as one of the worst owners in the league. The traits that made him a trading titan failed him on the field. You can read a balance sheet and predict the mechanics of a financial bailout with cold math, but you cannot model the volatile, messy emotions of athletes, coaches, and fan bases. Tepper's success demonstrates that value often lives in the data points everyone else is too overwhelmed to read. You just have to strip away the emotion, read the primary source data, and look for value in the exact places where everyone else is too afraid to look.